Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to JP Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. With the risk of an imminent escalation of the Middle East war receding a little this week, it turned out to be a good week for equity markets, with strong rises in most regions, notably only except across the European continent. So we had Hong Kong and China both rising by more than 8% over the week, followed by Nasdaq up 4%, FTSE remarkably up by 3%, and now well over the 8,000 mark that it's taken so many years to breach. S&P 500 up 2.7%, and the all-share index also up slightly ahead at 3% over the week. The Japanese market somewhat behind, up 2%. So all this despite the fact that we saw an increase in bond yields over the course of the week, partly influenced, I think, by the latest inflation figures in the US, which suggested that inflation on the measure preferred by the Federal Reserve is coming in a little bit above expectations again, and therefore pushing back yet again the idea that interest rates are coming down any time soon. That also had an influence on the trend of UK gilt prices, which were all down as yields rose across almost the entire maturity spectrum. In the US, the long bond is back up to levels of approaching 5%, which is often an important behavioural threshold. So we've had a curious week, therefore, in which both bond yields have been rising and stock markets have been performing strongly. Helped also, I should say, by the latest earnings results season in the US, which saw some good numbers from some, but not all, of the magnificent 7 big tech stocks. Notably, Alphabet, that's Google, and Amazon being marked up, while Meta was down something like 10%. All this reflecting markets' reaction to their latest statements about the amount of capital expenditure they're going to have to put into developing artificial intelligence products. Over here, as I said, the FTSE 100 index was in good form, up 3%, and the all-share likewise, but the Investment Trust Index somewhat lagged that, I'm afraid. It was up around 0.6% on the week, although if you look in detail at the makeup of the investment trust universe, it actually was a very positive week, with more than 240 trusts seeing their share prices rise over the course of the week, and only 39 experiencing declines, most of the latter being alternative asset trusts reacting negatively either to specific news or those rising bond yields. On the positive side of the ledger, the gainers were led by Gresham Energy Storage, the battery storage company, bouncing back after its very traumatic decline in the first couple of months of this year, and also by Hipgnosis Songs, which is now facing potentially 2 rival bids to take it private, and that saw the share price up again sharply this week, now over the initial issue price. I'll be discussing that and other news items later in the podcast with Andrew McHattie, the editor of the Investment Trust newsletter, one of our regular guests on the podcast. Among the other topics, we will be reviewing the markets and all the latest news from the investment trust sector. Of course, you can find details of all the latest results if you're a subscriber to the Moneymakers Circle, along with comments from me on the latest news, plus our latest investment trust profile, which this week features Artemis Alpha, the interesting niche UK equity specialist. And coming up in terms of profiles, we have VH Global Sustainable Energy Opportunities, Henderson High Income, and CQS Natural Resources Growth and Income. So plenty for the diligent to study if they so wish. In terms of specific investment trust news, I'd highlight the fact that there were some dozen companies reporting their latest annual results, though we are now some way on from the end of last year. Some of the later reporters are coming through. Of those, I think we could say that the best numbers were posted by Menhaden Resource Efficiency, ticker MHN, which reported NAV total return of 23% in 2023. So an excellent result there. And also good double-digit returns reported by the Martin Currie Global Portfolio, ticker MNP, and an 8% NAV total return from Henderson Far East Income, ticker HFEL. That was somewhere in the middle of the range of its two benchmarks that it uses to compare performance. At the other end of the scale, we saw disappointing results from Abrdn European Logistics Income, ticker ASLI, which has had some well-documented issues, NAV total return minus 17% last year, and also some disappointing results from VPC Specialty Lending, ticker VSL, which reported NAV total return down 9.5%. As I say, you can see all the details of these and some interim results that came out as well if you go to the website. Elsewhere, amongst the news that came out, apart from those two bids for Hipgnosis songs, we learned that Riverstone Credit Opportunities, ticker RCOI, has become the latest trust to propose a managed wind-down following a disappointing experience. And also, there was a newspaper report that suggested that Abrdn New India, one of the 4 investment trusts that specialise in the Indian equity market, has received an approach from 2 of the others, suggesting some form of combination. Abrdn, I think, being known to be in the process of consolidating its portfolio. This actually is one of the larger trusts in the segment, with a market cap of around 370 million, but trading at a discount of around 18%, unlike some of the other trusts in that sector. We also learned that Smithson, ticker SSON, the global smaller companies trust managed by Fundsmith, has passed its continuation vote with a 90% vote in favour, although there was a bigger vote against the reappointment of the chair of that trust, following the disappointment many shareholders felt when the trust initially proposed to skip its continuation vote. And finally, there were updates from a number of alternative asset trusts, including UK Wind and US Solar Fund. More on those in a moment when I sit down with Andrew McHattie to discuss what's been happening this week. On the macro front, I guess it is an unusual combination to see bond yields rising and equity markets performing very strongly at the same time. The question is that too good to last? Well, that's just one of the many conundrums which we've been facing all year as investors chop and change in their views of where the market is heading. Time will tell. So it was the turn this week for one of my regular catch-ups with Andrew McHattie, the editor of the Investment Trusts newsletter, which we're going to chat around some of the more recent announcements we've had in the sector. Welcome, Andrew, and let's kick off by talking about the bigger picture, which is essentially not much change, really. The investment trust sector remains on a sizable discount. Hopes it would come in haven't really materialised. Hopes of quicker interest rate cuts haven't really materialised yet, if anything gone slightly the wrong way since the start of the year. What's your feeling for the overall performance of the markets and, in particular, investment trust sector, Andrew?
Thank you, Jonathan. Well, I think you're probably right. That's a good summary. And I think I am feeling slightly less optimistic now than I was in January. And perhaps that's just the natural human condition that we all start the new year with plenty of optimism that then ebbs away. But I think it's really primarily about interest rates, that inflation is proving a little bit sticky. And as the prospects of falling interest rates just get pushed out a little bit further towards the back end of the year, so that's got the potential to depress equity markets, which I think had built in a fair bit of optimism about that. And I have seen an increasing number of articles in the media about the possibility of a significant pullback in US equity prices over the summer if we don't see those reductions in interest rates. And so on that basis, I think it's fair to be reasonably cautious at this point. And that's, I think, what we're seeing in the investment trust market, where, as you rightly say, Jonathan, the average discount has stayed out at about 15%. So we haven't seen too much narrowing there. But nevertheless, I do see some actual benefits of patience in this market, and I think we'll talk about that as this podcast goes on.
I was just looking at the performance of the Investment Trust Index, which is not totally representative of the universe, but does include nearly 200 of the larger names, and it's up 1.4% this year in share price terms, obviously a bit more in total return terms, which is not exactly particularly impressive. And the discount has, as I said, remained somewhere between sort of 15-16% around that level. But of course, within that, there's always sectoral performance. And I think, as we've seen, the major negative sectors have been property and infrastructure, the ones that are most interest rate sensitive. And I guess that's going to stay that way. We're not going to see a big recovery until we do see some change in the bigger picture outlook, I would guess. You'd agree with that, I think.
There's a sense in which those sectors are treading water at the moment, just waiting for central banks to hit the button. And until they do so, I don't think we're going to see any broad recovery in those interest rate sensitive sectors. But of course, there's always a lot of interesting stories within that, plenty of scope for stock picking and for improving your returns. And of course, we're never short of stories at the present time. There's a lot of corporate activity, a lot of individual performances, which are varying very considerably from that, as you say, rather mundane average.
Well, let's talk about some of those then. There may be a time quite soon when, for the first time in 4 years on this podcast, we don't have to talk about Hipgnosis songs, which has been an almost ever-present from the first moment for different reasons. There's been another twist in the tail here as far as shareholders in Hipgnosis songs fund are concerned. I mean, they've really had 2 weeks of really good news, and it got a little bit better this week, I think.
Yes, this has been an unremittingly awful negative story for so long that it seems quite remarkable that we've had some better news. And it seems to me as though we're approaching the end game now for Hipgnosis songs. And it is much better news for patient shareholders. And it looks like it might be a reasonable outcome because a bidding war has started, or at least a bidding tussle, between Concord Music, who you may remember bought the Roundhill Music Royalty Fund last year, and the owners of the managers Blackstone. First of all, Concord put in a bid of $1.16 per share for the investment trust, which was not bad actually and was recommended by the board. Then Blackstone came back and suggested they would be prepared to put in a bid. This was only indicative of $1.24 per share. And that was then trumped again by Concord Music, who came back with $1.25. Now, this is still not resolved. There's plenty of scope for further action here. But this is clearly much better news for Song shareholders. And what I think is interesting is that these bids are all above the most recent valuation by Shot Tower, which came about as a result of that special report. They put the last operative NAV at $1.11 per share. So we're seeing a bit of a premium here. And actually, this is not a terrible outcome for shareholders. If you have bought any time at all in the last 18 months throughout this period of terrible news, then you're sitting on a profit now. If you bought at IPO, you're sitting on a profit now. And of course, for many people, if you include the dividends that have been received, again, you're in the black here. So overall, this could be a decent outcome. And my feeling at the present time is that if you are a shareholder, and many of us are, including myself actually, that you're probably best off just sitting tight and waiting for this to play out. I don't see that there's very much downside risk here because it seems extremely unlikely that both bidders would walk away at the same time. But potentially there's a little more upside. I wouldn't say there's a lot. I don't think we're going to get a much bigger premium, but there could be more news to come.
Well, one issue then will be, this is all very well, but how long is this going to take to all get sorted out? We don't yet know whether Blackstone and co are going to come back with another offer or whether they're just going to put in a matching bid, which they're entitled to do, or at least they claim they're entitled to do, but the board is actually disputing that, I think. So your fine legal brain, Andrew, do you have an insight into exactly who's right about that? Or is this all just part of the jockeying or the tussle as you describe it?
I think you might be overstating my capabilities there, Jonathan. But anyway, it's a really fascinating wrinkle, this, because you're quite right. In theory, Blackstone have a right just to match the bid. But then that raises the question of why they didn't just match that initial Concord bid of $1.16. And I think the fact that they offered a little more rather indicates that they're not entirely confident about their ability to enforce that right. And on that basis, I think we might just be able to eke out a little extra value here. We'll have to see. And I think it's probably a mug's game to try and forecast exactly how this is going to end. But I don't think it'll take too long from this point. I think we're very much in the final stages of this one. And if you have been patient throughout this quite extended period of negative news, then I think we can probably wait just a little longer.
So just to put that in context, suppose it goes out at the highest of the current prices on offer, that 125 cents, then obviously it hasn't been a dividend recently and there won't be any more, presumably, in that eventuality. So essentially the share price today in sterling is around £1.03, something like that. So essentially what we're saying is if you were there at launch, you'll get your money back eventually, and you'll have had the dividends in the meantime, which I think works out at a return of about 22% overall since launch, which isn't great, but it's not as bad as it looked at one stage when the shares were languishing around 60p and all the argy-bargy was going on, which was only, just a little over 6 months ago. So assuming that we end here, do we mark this down as a triumph for corporate governance in the end in this particular case?
Well, I think maybe that's a little optimistic. I'm not sure. We can put it down to experience anyway and learn from it. And I think it's a great pity, actually, that this trust is disappearing, because this is effectively the end of any access that we have to the songs market, which I think was quite interesting as a portfolio diversifier. It made a lot of sense to have these uncorrelated assets, and now they're disappearing. But fundamentally, yes, it's not a bad outcome for shareholders. And I think maybe there's a bit of a read across here for the investment trust sector as a whole, that we're in this slightly depressed period where the news flow is often a bit negative and we're hearing all of these corporate problems and a bit of mismanagement and NAVs being marked down and people not believing the NAVs anyway. But fundamentally, if these trusts own good assets, then finally someone will come and buy them because they are worth a little bit more than the shares are implying on these big discounts. And of course, across the sector, we're seeing a lot of trusts still on very big discounts to their asset values. And I think perhaps the eventual outcome here with Song should give encouragement to those shareholders who are patiently sitting, waiting for those valuations to improve elsewhere. So it's been a really interesting situation. And I think, as you rightly say, Jonathan, in the end, it's not that bad for shareholders.
Yeah, I think what I meant by talking about corporate governance was if we just sort of review what happened, there were issues raised before about the management of this trust, but when the shares went to a big discount, they went to a very wide discount, which is a good signal of trouble, as well as issues around interest rates and so on. And then the shareholders voted in such a way that it engineered a change in the board. And the board since then has actually engineered an auction effectively. And so this has been a useful, as you say, example of what shareholders and boards combined should be able to do. So there was pressure from some of the larger shareholders to take action and to help bring in a new chairman and so on. So there was a sort of cleansing of the old board, which, let's be honest, didn't inspire much confidence by the end. And so we've seen this kind of cycle. As you say, maybe that is a good example of a template of what can be achieved, but is not always achieved. So it's not simply that you sit around and wait for good things to happen, but actually you need some kind of mechanism by which shareholders and boards can be energized into doing the right thing, albeit it takes quite a long time.
The new board here was absolutely crucial in providing that extra impetus, wasn't it? And I think that was the change that really has brought about this improvement and this shift towards this final outcome. So yes, I think if you want to put a positive spin on it, you can say this is all part of the process and the mechanism and the structure and that it's all worked out over time. I think, though, we have to bear in mind that that initial board really didn't seem to be quite of the same quality and didn't have quite the same amount of enthusiasm and energy that the second board has brought to the proceedings. And also there were lots of management issues and very difficult clauses that were achieved by the manager and were not totally transparent for shareholders. So there were a lot of issues here that we can learn from. And yes, perhaps in the end, it is the validation of the structure of investment trusts with their independent boards.
Yeah, and of course we also have to bear in mind that some of these trusts that had run into difficulties all came to the market at a time when discounts were very, very narrow and everybody was very bullish about the sector. So in a way, it came sort of a bit easier for things that weren't quite right to slip through the net, if you like, in a very bullish environment, which no doubt one day we'll get back to. We're not there at the moment. Well, let's see if we do take a look across the rest of the universe, and there are trusts trading on very wide discounts, as we know. Just to give some examples, I'm just looking at the ones on the biggest discounts at the moment, and we're looking at things like Digital 9, we know about, Regional REIT, the battery storage trusts, and one or two other, Phoenix Free Deutschland, for example, triple point social housing, these are all on notional discounts of 50% or more. So one can't generalize that if you just sit back and wait for these things to sort themselves out, they will get sorted out. But do you think that this is all just part of a process of consolidation that won't end until all those trusts are either put right or just disappear for whatever reason?
Yeah, so Jonathan, as you were going down that list, I was mentally ticking them off and thinking about which ones of those were indeed going through corporate restructurings or thinking about winding up or selling assets or reducing their debt. And I think most of them are, because these trusts are working through their troubles. And I think we're seeing a lot of that going on at the present time. We will see more trusts disappearing from the sector. This period of shrinkage that we're living through is far from finished. And so, yes, I think on the whole, actually, this, again, does speak well to the structure of investment trusts, that these issues can get resolved and these very wide discounts can eventually shrink. But it's not always a quick process. And actually, I think for that reason, it's a flawed strategy to try and identify trusts on very wide discounts in the anticipation of those closing pretty quickly and therefore you coming out with a profit on the share price. I'm not sure that's a good method of approaching the market because it can take quite a long time. Sometimes you're disappointed because, of course, these discounts do tend to be indicative of underlying problems. So you're not necessarily buying the highest quality trusts if you're taking that approach.
Well, let's talk then about a whole sector which has been through this process, and that is the battery storage trusts. 3 of them only came to the market relatively recently as a new sector for the investment trust world. And they have run into difficulties, or at least their share prices have fallen very, very sharply, particularly in the case of the 2 which are solely operating in the UK, Gresham House Energy Storage and Harmony Energy Income Trust. But the share price have picked up a little bit in the last couple of weeks or so. What do you think's going on there at the moment, and what would you be looking for to see happen over the next few weeks and months to see if they can come back? They've had a bit of a heart attack, if you can put it that way.
We have seen a bit of a bounce, thank goodness, and it was probably overdue as far as shareholders are concerned. This is another case, actually, of a really good idea undermined by the harsh realities of the modern world, where things don't always work out quite as you think they will. And clearly, in this era of renewable energy being so important and also somewhat unreliable, we do need to have battery storage to make sure that we have a nice, easy flow of power from the national grid. But these battery storage funds have found that they've not been used quite as much as they'd hoped, and the revenues have come in a long way below forecast. But we've had 2 updates, actually, from both Gresham House Energy and Harmony Energy over the last couple of weeks. So it's worth talking about those in just a little bit of detail. In the case of Gresham House Energy Storage Fund, it issued an update on the 18th of April, so just over a week ago, which was quite detailed, actually, about improvements in the trading environment at the start of the year and the way in which the national grid has actually started to increase its use of the battery storage facilities. At the same time, it's amending its debt covenants, reducing its debt a little bit. It's got some new operational capacity coming on stream as new projects are completed. And it's conserving its cash. So it's saying it's not going to pay any more dividends or do any buybacks for the rest of this calendar year. So whilst its NAV was down by 11.6% over the quarter, which sounds quite bad, it was down to 129 pence per share, which is still a long way above the current share price of around 52 pence. So there's a great deal of pessimism already built into the share price here. But Gresham House are essentially saying, well, things are improving. And then they issued actually a supplementary update a week later, again speaking of further improvements in March and in the first half of April. And they put some figures on this, saying that effectively from January and February, when their revenues were something around £40,000 per megawatt, actually that's increased in the first half of April to £71,000. So a very welcome recovery as some of the metrics that the National Grid is using have changed. And also the trading spreads have increased, which allows them to make more money. So I think the outcome here is that revenues are clearly improving. They are still below forecasts, but things are getting better here. And I think that's the reason why the shares have actually bounced quite strongly in Gresham House's case from a low of 37 pence up to 52. And we've seen something very similar actually from Harmony Energy, which again issued a trading update saying very much the same thing, that actually revenues are starting to recover now. And we've seen the shares there bounce up from about 39 pence to 47.5. So yes, things are improving. And my sense is that this is likely to continue, that we're likely to see revenues coming in at a much better level for these trusts over the coming months. They may not get back to where they were and they may still be below forecast. But I think given the pessimism that is baked into the share prices, I wouldn't be a seller at this level.
So, I mean, one of the issues, obviously, it's often the case if you stop your dividend, that's always a signal to the market and not one that is well received, particularly if you're in an alternative asset sector where people originally bought these things because of the yield rather than hoping for massive capital gains. So that's always a last resort, really, for a board in this kind of situation. So I think that will take some time, won't it, for that sort of stigma, if you like, to pass. And in terms of the relationship between Gresham House Energy Storage and Harmony and Gore Street, which is the one that doesn't only operate in the UK, that's on a smaller discount, still 44% discount at the moment, and the share price is around 64p, something like that, compared to an issue price of 100p. And the other two are worse. Would you expect there to be continued differential in the performance between those three individual trusts?
They all have individual elements to them. And you're quite right that Gore Street is really significantly different because it has operations principally outside of the UK. And those markets operate with completely different metrics and the returns are going to be different. And then with actually Gresham House and Harmony, they are again different because they have different strategies to reap their revenues and also different types of batteries. So they have a different mix of 1-hour batteries and 2-hour batteries. And so it's quite difficult to compare them directly. It's quite sensible to have a look at the valuations and take your pick. Some investors, if you're thinking of getting into the sector to take advantage of this difficult period and hope for recovery, then you may want to buy more than one to have a mix. It's difficult to say exactly which one is likely to be the top performer over the next 6 months, which is perhaps really the point of the underlying question.
Indeed it is. The other point there is that their stated assets at least add up to about 1.7 billion. So investors have put a lot of money into this sector in the hope that it will become a more prominent feature of the UK electricity generation market. And obviously there's high hopes there. And we'll have to wait and see whether these short-term problems, which is a combination, I think, both of the general power price environment and the technical factors around whether or not these trust services are going to be used by the national grid, whether they get resolved or not. Let's talk about the renewable energy sector then more generally and pick out a couple of other names that have been reporting or taking action in the face of what is a general trend of lower power prices and wider discounts. Let's start with Greencoat UK Wind, which is the largest of all the renewable energy trusts. They put out some figures recently. What did you make of those and their announcements?
I reckon this is the go-to trust for most investors, actually, who are starting to gain exposure to the renewable sector. As you say, it's one of the largest and most liquid, and I think it gets the most publicity. And yes, it's an important one to talk about for that reason. It released its first quarter NAV, which was 160 pence, which was down a little over the quarter, principally due to the change in power price assumptions. The weakness in power prices is an issue here, and it's quite well known in the market that Greencoat UK Wind is a bit more exposed, a bit more sensitive to power prices than most of the other trusts in the sector, because it doesn't have hedging in place and forward contracts. And so that's the reason why the NAV's come down a bit. But nevertheless, the shares are still trading on a 13.5% discount. It's paying a good dividend, which is offering a prospective yield of just over 7%. So I don't think there's any particular issues here unless we see really sharp further declines in power prices. But my sense there is that actually looking at the forward curves, it doesn't look too bad. And again, I think we've been through this period where there's a great deal of negativity in the market about future power prices. And that's probably, again, in the price here.
So I guess the point about the power prices is, as I understand it, they've gone back to the level they were before we had the whole crisis around Ukraine and everything else that we had in that period. And so it's a question really of hoping to rebase around that level, which has produced some exceptional gains in the last 2 or 3 years, and then taking steps to manage balance sheets and manage the capital allocation policies. I mean, that's now a general trend, I think, across the renewable sector, some of them doing it better than others. Shall we talk about US Solar Fund, which is another renewable energy trust, where they perhaps have a little more difficulty than some of their peers? Tell us what's going on there.
There's more work to do here, that's for sure. Yes, this trust has had a checkered history. It didn't start off very well and effectively put itself up for sale, only to discover that no one wanted to buy it. So instead, the trust appointed new managers in the form of Amber Infrastructure Group, who are actually quite large, significant managers who also manage international public partnerships in the investment trust space. And they've gone about really reassessing the assets here and working through the problems that the trust has. And last year, the trust sold its share of quite a big asset in the Mount Signal 2 asset, which meant that it got some cash in, but its dividend cover has dropped. And so as a result, actually now, there's good and bad news for shareholders. The good news is that some of that money is coming back to you through a tender offer, which is at the NAV less 2%. Now that works out at 76.4 cents per share, which is a very big premium to the 47 cents share price. So you must tender all of your shares for that and hope that maybe some other shareholders don't, so you get more than your fair share. It's not a particularly big bump you're going to get there, because actually that's only about 7% of the overall asset value here. So it's a welcome return of money, but it's not a big deal. And then I think is balanced by the bad news, which is that because of this asset sale, clearly the trust's revenue has fallen, and that means that its dividend was no longer covered. And it also looked a little bit out of whack anyway, because the yield was very high, over 10%. And so the trust has decided to slash that dividend actually from 5.66 cents per share down to 2.25. So that's a really sharp reduction. And again, that's bad news for people who bought these shares for the dividend. But I think there's a balancing factor here, which is that very often I've seen this happen actually a few times in the last couple of months, Jonathan, that trusts that have been paying what looks like an unrealistic dividend have found that when they've cut the dividend, it's been quite good for their credibility in the market, and the share price has often improved. So in this case, I think we may find that perhaps that income return is replaced by a bit more capital return. But there's an extra factor to throw into the mix here coming up, which is that the trust has a continuation vote due on the 21st of May this year. And whilst it does need 75% of those voting to vote for the trust to cease, if that's what they would like, so that's quite a high hurdle, I've been reading that that is a possibility. And it may be that actually shareholders are deciding they'd like a bit more than that 7% of their money back. We'll have to see.
Yeah, just to finish on that one, I mean, the share price has perked up a tiny little bit in the last few days, but it's not as if the discount is narrowing dramatically in any way. So it does suggest that that tender offer isn't going to make a huge difference, as you say, and that there's still a lot to play for when that continuation vote comes round, even if it will still take time after that for anything that can be realised to come through. That is another common theme, as we've been talking about. These things can't be wound up very quickly or easily. Let's quickly talk about a related sort of trust, which is Riverstone Credit Opportunities. Tell us about that one and what that does, and what are the issues around that one.
We'll talk about some of the same themes again here. This is a relatively small fund. It's a US energy infrastructure debt fund, somewhat esoteric, and it was coming up for a realization opportunity in May. And having consulted with some of the largest shareholders, the board has realised that quite a lot of those shareholders would be wanting to take up that realisation opportunity, and that would leave the trust probably under $50 million of market cap, so really too small to continue. So it is now proposing a managed wind down, which is not too much of a surprise. And I think this has been coming. And so the trust actually hasn't been buying very long-dated assets. It hasn't been making long-dated loans. And it says actually it should be able to realise around 90% of its assets within a year. So I think this will be a comparatively painless winding up if that's what shareholders vote for. And I think that's probably reflected in the rating in the market, where the shares are on roughly 12.5% discount to the NAV. So there's not so wide a gap here as there was with US Solar. And I think this is another trust about to disappear.
And this trust is managed by the same team who manage Riverstone Energy?
Yes, it's the same fund management business. It operates in a very different way, but yes, they have the same parent.
And that trust has also been on a much longer, dating back a long way, an attempt to sort out the fact that nobody really liked the shares very much. They performed very poorly for a period. And since 2020, they've actually bought back quite a lot of their stock, haven't they, I think, over that period. And it seems to be working in the sense that the discount is narrowing and the share price is recovering at least. Will that one survive? Do you think that's become quite small? It was a very large trust originally. Now it's, I think, about 250 million market cap. But they have been buying back a lot of the stock, have they not?
Yes, that's an interesting one, that one. If you got your timing right on that one, you could have made a great deal of money, because you're quite right. It's been very volatile. It had a terrible period followed by actually a tremendous period in share price returned. Because of that, actually, it may still have some fans in the market, and I'm not sure everyone would like to see it disappear, which in any event is probably not straightforward. So that one may survive. I think there are probably quite a few trusts on the fringes of the sector like that, where we'll have to wait and see whether they make it through this tough patch or not.
Yes, as I recall, Riverstone Energy, they got some opprobrium, bit of a stigma there too, because they tried to issue shares at a discount and that didn't go down well some way back. So it's taken time for them to come back into favour, but they seem to be doing a lot of the right things now. Let's talk then about private equity. What's your impression? We had a lot of excitement towards the end of last year after Pantheon announced its big capital allocation policy, including many more buybacks, and other trusts have followed to varying degrees with plans to try and reduce the very wide discounts there. What's your feeling about that sector now and what we've learned over the last, say, 3 months or so?
I've been spending quite a lot of time looking at private equity, and I spoke to a private equity manager last week, and I'll be writing about that in my newsletter. But I think it's especially interesting at this point in the context of what we've been discussing, that actually there's a lot of money coming back to shareholders, whether that's through takeovers or tender offers or winding ups. You're going to have money coming back into your broking account that you might need to reinvest. So I think it's worthwhile looking at the other sectors on very wide discounts. And the obvious one to look at, first of all, is private equity, where I think we've seen these wide discounts existing for the last couple of years, partly on concerns about write-downs on the valuation of private assets and the fact that NAVs lagged behind the market. But actually, this is a well-established sector where there's a very long history here of trusts valuing their assets on quite a conservative basis and getting quite good bumps to their NAV when they sell those assets. So I think actually there's a lot of hidden value here. And I've been carefully looking at all of the most recent announcements on NAVs to see what the trend is. And this is an important time of year because a lot of the end of February or end of March NAV announcements take into account the year-end revaluations that have occurred. And I say revaluations, but of course they could be devaluations. But on the whole, they've been pretty good. And so I'll just run through them very quickly here, just the most recent month-end announcements. So Oakley Capital was up 1.6% in NAV terms for the last quarter, in spite of a foreign exchange headwind. HarbourVest Private Equity, its March NAV was up 1.1%. Pantheon's March NAV up 0.9%. Abrdn Private Equity up 0.3%. On the whole, they've been small positives here, And I think the overall trend here is quite good. And yet, we're still seeing these extremely wide discounts. One or two of them have come in. We have seen some benefit from Pantheon's big buyback. And actually, Abrdn private equity has narrowed to a 27% discount. But that's not always the case. And the HarbourVest private equity trust, for example, is still on a 43% discount. There's a lot of value here on discounts above 30%. And my sense is that as 2024 goes on and conditions ease in relation to financing and interest rates and the ability of private equity buyers to maybe establish some exits through IPOs or through trade sales, I think we'll just see things improve in this sector, and yet you still have this chance to buy in on very cheap ratings.
Okay, well, we'll see about that. That is an interesting thought. Obviously, there is a sort of bigger picture going on for the last couple of years. We know that private equity houses have found it harder to realise the value of their assets because the public markets have been so weak. But that may be changing, and the fundraising also has been difficult for them because they haven't completed their realisations of their existing portfolios. So, interesting one to watch. Let's finally then talk about a manager change, which may be of interest to people, and that is the Alliance Trust recent announcement that they were going to drop Jupiter, following the news that Ben Whitmore, their very experienced UK equity manager, is leaving Jupiter to start his own firm. What did you make of that announcement, Andrew?
I think it makes a lot of sense. The context here is that Alliance Trust uses the consultancy firm Willis Towers Watson to choose 10 managers to ultimately manage the portfolio on a day-to-day basis, and they're each given an allocation of assets. And Ben Whitmore at Jupiter was one of those, but he is leaving to establish his own boutique firm. And that obviously comes with a bit more risk as he's establishing his new business. So it made sense really for the trust to move that money away to a different manager. So they've picked Arga Investment Management, a global value manager with offices in America, India and London. And they've been given 8% of the assets, with the other 1% that Ben previously had allocated to the other managers. And what I like about this is the fact that it's actually quite an easy process and there's no trouble here for shareholders. Whereas, of course, if you're a more traditional investment trust and your manager decides to leave to establish his own boutique, the board then has quite a difficult decision to make. And it could be really quite an important choice whether they move with the manager, stick with the existing management firm, whether they hold a beauty parade of managers, or they indeed instigate some kind of corporate action. But whatever the choice is, that's a much more major decision. And I think actually the structure here at Alliance Trust means that this kind of manager change can be adopted quite smoothly and easily without any great upheaval or uncertainty for shareholders. So my sense here is that actually the multi-manager approach is actually becoming a much more comfortable fit in the sector. And during this period of upheaval, I think it makes actually quite good sense.
I guess one thought you might have is Ben Whitmore has got a very strong reputation, and that's why he's able to set up a boutique firm. A lot of managers prefer to manage investment trusts, and they do open-ended in some ways, but I doubt we're going to be seeing an investment trust from him at this stage in the cycle. Though I think it'd be welcome because he would operate in the UK all companies sector where we are, I would suggest, quite short of really good, experienced fund managers. I don't know if you'd agree with that. Obviously, we have Alex Wright of Fidelity's Special Values, who has a strong reputation and is a very large trust. But I think we could do another one in that sector, don't you think?
That's an interesting question, isn't it? Whether we have enough in the UK as regards choice and whether we have enough of these value managers. To be honest, I think if the manager is of the right quality, they're always very welcome in our sector. And clearly Ben Whitmore does have a very good track record. And who knows, in a year or two, when conditions are better, perhaps he'll be able to introduce something. And of course, it could well be that Alliance Trust will come back to him once his firm is established as well. So he could be back in the sector. We've seen that before. And yes, at the moment, actually, there's an argument to be made, I think, for this value approach in the UK. So my trigger for thinking about this at this point was the large bid this week from BHP for Anglo American, which was possibly an opportunistic bid based on the rather low valuation of assets on the London market. And we've seen a lot of media coverage of this recently, that London is not attracting very high valuations. And we know that ourselves, that the London market's been out of favour for a long time. And I noticed as well in the most recent quarterly results from Fidelity Special Values that actually 5 of its top 10 performers over the last 6 months, in fact, were from takeovers. And so I think value managers at this time could find that they're benefiting quite considerably from M&A, and it could be a very good period for them. On that basis, it's a shame that Ben Whitmore isn't able to launch anything right now, but we'll see.
Well, that's definitely one for the future. We'll encourage him to look at the investment trust sector and look to join, where we have some other very splendid examples of well-run, well-managed vehicles for long-term savers and indeed others. So thank you, Andrew, for your thoughts this week. Always helpful and interesting. And we'll look forward to having another go in about a month's time.
Splendid. Thank you, Jonathan.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.